guys, Peter Harper, Managing Director and CEO of the Asena Family Office. For those of you who are not familiar with the business, we advise foreign family offices and private clients on US direct investments and mergers and acquisitions. So today is the next video in our family office series, and we wanted to touch on family office fee structures. But before we do that, I think it's useful to kind of recap on what a family office is, and why there's such a massive uptick in family offices being created today. So family offices are an organizational structure established by families of significant wealth to support their economic and private endeavors, right? So think about when if families had a massive liquidity event or a huge inheritance event, extraordinary amounts of capital, and there's a need to stand up some form of organizational infrastructure to manage the capital and manage non-income producing assets. So that might mean establishing a C-suite, so a CEO, Chief Investment Officer, COO, CFO to manage investments and non-investment costs. So private assets like houses, cars, boats, planes, and then all of the infrastructure and employee issues that are associated with that. A multifamily office is that on a fractional basis. So either a family doesn't have the means, doesn't have the wealth to justify a single family office, or they just don't want the complexity. They don't want the operational complexity of having to manage a team at the level that you have to run your own family office. So the fee structure we're going to talk about is largely probably more relevant to a multifamily office setting, because in a single family office, a lot of this stuff might be done in-house by people that employees that are on real P&L costs, right? Just to put it into context, for a single family office normally to run in-house overhead, you're looking at sort of 7 to 10 million per annum to run that for most, minimum for most of your family offices. So the fractional support is the right way to go for most of the market, right? And how's that charged? The most customary is effectively a fee based on assets under management. So a percentage of funds under management or assets under management that are looked after by the multifamily office, that will be sufficient to cover all services within the business. So tax, accounting, wealth management, estate planning, and any other ancillary services that might be relevant to the particular client's needs. Some family offices of scale might still prefer, rather than having a fund model, to have some sort of fixed fee arrangement or hourly based arrangement, right, that you would in any other sort of professional services model. But that's not as customary. Because the biggest thing that you want is when you think about the multifamily experience, you want to feel, even though these people are external to you, you want to feel like they really are part of your internal team, right? And in order to do that, you need to make sure that you've got you've got less variability around your overhead and fixed costs to make sure make sure the multifamily office can support capable people to support your needs. Thank you.